Hello, and welcome to my channel. Peer-to-peer P2P lending has emerged as a popular investment alternative, offering individuals the opportunity to lend money directly to borrowers without the involvement of traditional financial institutions. And through online platforms, investors can connect with borrowers seeking personal or business loans, potentially earning higher returns compared to conventional investments. However, as with any investment, P2P lending carries both advantages and disadvantages that investors must carefully weigh before committing their capital. This explores the key pros and cons of investing in P2P lending, helping you make an informed decision. 1. Potential for higher returns. One of the main attractions of P2P lending is the potential for higher returns. Traditional savings accounts and bonds often offer relatively low interest rates, especially in times of low inflation. In contrast, P2P platforms typically advertise returns ranging from 5% to 12%, which can be appealing to investors seeking better growth prospects for their money. Additionally, lenders can choose to diversify by lending to multiple borrowers, thus reducing risk exposure to a single loan. By carefully selecting loans based on risk profiles, investors may achieve better returns than through traditional financial products. However, the higher returns come with added risk. P2P lending is inherently more risky than bonds or savings accounts, as borrowers may default on their loans. Therefore, investors must be cautious and understand that higher returns come at the cost of greater uncertainty and potential losses. 2. Accessibility and flexibility. Another advantage of P2P lending is its accessibility and flexibility. Unlike traditional investments, which often require substantial capital or are limited to accredited investors, P2P platforms allow almost anyone to participate with smaller amounts of money. And some platforms accept investments as low as $25, making it possible for individuals to start small and grow their portfolios over time. Additionally, these platforms offer a wide range of loan options, allowing investors to choose which borrowers or types of loans they want to support, whether personal, business, or real estate loans. The flexibility of P2P lending, however, can also present challenges. Since many P2P loans have relatively long terms, ranging from several months to several years, investors may face liquidity issues. Unlike stocks or other investments that can be sold quickly, P2P loans generally cannot be liquidated until they mature. This lack of liquidity means that investors must be prepared to have their money tied up for extended periods. Transparency and control. P2P platforms provide investors with greater transparency and control over their investments. Most platforms offer detailed information about borrowers, in credit scores, employment status, and loan purposes. This allows lenders to make informed decisions and assess the level of risk associated with each loan. More investors can choose to fund only the loans that meet their risk tolerance and preferences, giving them control over where their money goes. Nevertheless, the increased control may be overwhelming for some investors. Unlike traditional investment vehicles, where fund managers handle investment decisions, P2P lending requires active involvement. Investors need to spend time researching borrowers, managing their portfolios, and reinvesting repayments. For those with limited time or expertise, this hands-on approach may be more of a burden than a benefit. 4. Default risk. One of the major drawbacks of P2P lending is the risk of borrower default. Since P2P loans are often extended to individuals or small businesses with limited access to traditional credit, the chances of defaults are higher compared to conventional loans. And while P2P platforms do assess the creditworthiness of borrower, there is always the possibility that a borrower may be unable to repay the loan, resulting in financial loss for the investor. To mitigate default risk, investors can diversify their portfolio, by lending small amounts to multiple borrowers rather than concentrating their funds in a single loan. Many platforms also offer features such as Auto Invest, which can spread investments across a variety of loans to reduce risk. However, even with diversification, defaults can still occur, and investors should be prepared for potential losses. 5. Platform reliability and fees. Investing in P2P lending also depends on the reliability of the platform used. With numerous P2P platforms available, it is crucial for investors to research the reputation, track record, and security measures of each platform before committing their funds. That reliable platforms will conduct thorough borrower assessments, maintain transparency, and offer customer support. However, newer or less reputable platforms may lack these safeguards, exposing investors to greater risks. In addition, P2P platforms typically charge fees for their services, which can eat into the potential returns. These fees may include origination fees, servicing fees, and late payment fees, reducing the overall profitability of the investment. Investors should carefully review the fee structures of each platform to ensure they understand the net returns they will receive after expenses. 6. Regulatory and legal considerations. The regulatory framework surrounding P2P lending is still evolving, which can create uncertainties for investors. In many countries, P2P lending is subject to lighter regulation compared to traditional financial institutions, which can be both an advantage and a disadvantage. On the one hand, fewer regulations mean lower overhead costs for platforms, potentially leading to higher returns for investors. On the other hand, the lack of strict regulatory oversight can expose investors to fraud, platform failures, or legal disputes. It is important for investors to understand the legal protections in place for P2P lending in their country. Some platforms may offer insurance or guarantees in case of borrower default, but these protections are not universal. As the industry continues to grow, regulatory changes may impact the risks and benefits of P2P lending, so staying informed about legal developments is essential. Peer-to-peer lending offers an innovative way for investors to diversify their portfolios and potentially earn higher returns than traditional investments. However, the risks, including default, liquidity issues, and platform reliability, must be carefully considered. For those willing to actively manage their investments and tolerate a higher level of risk, P2P lending can be a valuable addition to an investment strategy. As with any investment, thorough research and a clear understanding of the pros and cons are essential for success in P2P lending. Staying updated on industry trends and platform changes also crucial for minimizing risks and optimizing returns. Thanks for watching. Do like, share, and subscribe. See you in the next video.